All right, investors are buying homes at record pace. Are they the ones responsible for the huge price gains and putting property price points out of reach for everyday people like you and I? We'll talk about that in a second. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is February 22nd. So it's 2/22/22, one of those unique number days in the calendar. Hope you're doing well. Randy Patrick here, putting the realism back in real estate. And yeah, we needed some of it this day because things are once again out of control. Nothing surprises me anymore. But if you are interested in looking at what's going on behind the scenes in your own property, neck of the woods, etc., this video is brought to you today by our friends at Foreclosure.com. So go to gethousingdata.com. That's gethousingdata.com. Check out what we got going on there. You can join. There's actually a 7-day free trial. It's my affiliate connection with Foreclosure.com. So go to gethousingdata.com. That's gethousingdata.com. These guys are the number one provider of distressed listings across the U.S. So check it out. You can at least get a handle of what's happening and see the changes. I know people have already talked to me about this. They've seen what's going on over the past few months, things changing. Very interesting. So lots going on. We're going to talk about investor stuff. We're going to talk about NAR, National Association of Realtors. They released their existing home sales report for January. We're also going to talk about what? Well, guess what? Today is a Tuesday. It's the last Tuesday in the month. That means Case-Shiller data is released. So we're going to talk about Case-Shiller as well. So first of all, let's hit NAR. This is the January 2022, so just last month's information for existing home price sales. Median price point at about $350. It's been kind of plateaued for the past few months now in that $350, $352, $348 range. So a little bit of an increase on that, I believe, there, but just sort of hanging around. That's your median price point across the board. Median means exactly in the middle. Okay, it's not the average price point. If we take a look at what's happening, that was a 15.4% year-over-year increase. So we saw some big increases back in the summertime. We saw a little bit of a slowdown. Looks like increases are picking up on a very slow linear level right now. So obviously be aware of that. It's the percent year-over-year home change. The existing home sales, so the actual volume of transactions since the summertime has basically, compared year-over-year, has been decreasing. Every month it's less and less. We can see January was a negative 2.3%. So the number of sales that happened this January compared to last January was an actual decrease. Again, that's probably going to be resulting for buyer sentiment and also lack of inventory. We take a look at what's happening in the marketplace. Well, first-time home buyers, 27% of the market was first-time home buyers, is down a little bit. Sales to investors up substantially from 15% to 22% of the market share. Cash sales up from 19% to 27% compared to last year. Distressed sales, because there's not much going on out there, because of things like foreclosure and eviction moratorium, having our market choke for almost 2 years, remain the same, 1%, no change from last year. Days on market, which is the days you put a property on the MLS, how long it takes to get under contract, shrunk from 3 weeks to 19 days. So that's what we got looking on here. I noticed the sale to investors and cash sales have had a similar, like a 7-point and 8-point increase. So could the increase in investors who are buying cash result for both things going on here? I suppose that probably doesn't make sense. So that seems to be a correlation. So ultimately, in the end, we see that there's larger distribution happening in the greater than 500K range. We can see the 500K range has got 16%, the 750 range 6%, the million plus range 6%. Obviously, the bulk of the deals happen at 250 to 500K range. The 100K to 250, 25%, and the sub 0 to 100K, 5% of all sales for this month. There's not many places across the country you can find homes for under 100K. So there you go. If we take a look at same thing, how the distribution here, what we're seeing is that obviously every month sales comparative to the previous year, less in the lower end. We're seeing substantial increases in the higher end. Okay, so when you see median price point kind of being dried up a little bit, it's because the way the numbers skew out here. Obviously, we have more sales, so greater distribution in the higher price points as compared to lower price points. So clearly that's going to change the median and the average prices as well too. So there should be no surprise there. I think that's just basic mathematics. Hey, if you're not already a subscriber and you like the information I provide and my take on things, if you'd help my channel grow and smash that subscribe button, I'd really appreciate that. And if you think you're a subscriber or know you subscribed, if you could just double check and resubscribe, I'd appreciate that as well too, because I've been losing subscribers. I just maintain my subscriber account. I lose as many as I put on, so which means something's going on behind the scenes that I can't control. So once again, I appreciate everyone's patronage, and you've been with me for a few years now, and I really do appreciate that. Let's continue to keep this this machine moving here, because it's getting fun now, guys. That really is. We've talked about it for a couple of years now. Things are changing. So U.S. home prices re-accelerate in December. So what was supposed to be, like we've had 4 months of decelerating appreciation, which is kind of like an oxymoron. So appreciation is still appreciating, but it's actually slowing down. So decelerating appreciation, 4 months worth. We thought that there's going to be a drop in December. It actually had an uptick, so it actually surprised people. It was projected to be 18%. It actually came in 18.56 year over year was the values of, from December 2020 to December 21. So that's a little bit interesting. Again, not like it's a huge number, but we're seeing some small trends sort of play out here. Phoenix, Miami, Tampa, highest year over year gains of the 20 cities surveyed, and ultimately, the thought processes here is that mortgage rates are taking off in January. That was the plan. So people maybe in December were sort of rushing to buy property, just knowing that, hey, we've got a limited time here where these great interest rates are available, and we're going to lose those in New Year's. That could have been some of the, impetus to move things forward quicker in December than what was projected, because typically December is a slower month in real estate historically. So that's why it's interesting. So CoreLogic, of course, Case-Shiller index reports 18.8% annual home price gain for the calendar. Year over year gain, 18.8. You have that's national index. You've got the 20 city and 10 city composite indexes here. Phoenix, Tampa, and Miami were the ones that actually have the top three home price appreciation gains over the 20 cities. Take a look at the bump here. So obviously the middle hump in this graph is the 2006 previous housing bubble. Obviously the far right where we are is the current month and year. And you can see that the past maybe 2 years, we've kind of jumped up in home price appreciation on a much more steeper line as opposed to a linear line that would be somewhat exponential, as I'm sure mathematicians would state. In this capacity, this is not a linear increase. It's a much steeper. So there you go. To put things into deeper perspective, I like this next chart because to me it sort of sums stuff up really well. When you take a look at it, the top lines, the national, the 20 city, the 10 city come next. So you go across the line. The 2006 peak was in July 2006. The trough was February 2012. The values today are 107.9% from the trough. So that's huge. And we're almost 51%. We're 50.9% higher than we were at the 2006 peak. So ultimately, what it's saying here is that if you bought a home in February or that area, like I'm going to say, plus or minus a few months either side of the trough, where we are today, you've probably doubled your money, or you've doubled your home value. So good for you, and congratulations on the astute purchase. That's awesome. So things are going. I didn't think we'd go over 50% on where we are, but we continue to do so. And listen, I think we're going to go a little bit higher as the summer selling season comes on, because we're going to have all the right things in place for that. And then once summer selling season's over, we'll start to see some quicker declines as things roll out into the change in the economy and more foreclosures becoming available and stuff like that. So we're going to get there. Let's go through this really quick. Okay, Atlanta, 21.9% year-over-year change. Boston 13.4, Charlotte 23.8, Chicago 12.2, Cleveland 13.3, Dallas 26, Denver 20.3, Detroit 14.5, Las Vegas 25.5, LA 19.3, Miami 27.3, Minneapolis 11.4, New York 13.6, Phoenix, Arizona, number one year-over-year price appreciation for like the 40 some odd month in a row consecutively. So 32.5, Portland 17.9, San Diego 25.9, San Fran 18.8, Seattle 23.9, Tampa 29.4. Tampa's number two, and Washington 10.5. I think it's interesting to notice that the lowest year-over-year appreciation out of this top 20 composite index was Washington at 10.5%. So when the lowest appreciation is in double digits, you got a pretty hot market here. So we're going from a range of 10.5 all the way to 32.5 with Phoenix and everything in between. It's interesting to see that some of these, we're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, half, 50% of the top 20 composite index have greater than 20% year-over-year appreciation, which is pretty significant if you ask me. All right, so let's move on. That's cool. Now remember, Case-Shiller doesn't equal NAR. NAR's National Association of Realtors. They do median house prices the next month because they have different statistics. Case-Shiller's are different calculations based on sales pairs, and they're usually an extra month behind. So when NAR's looking at January, Case-Shiller's looking at December. It's usually a 2-month drag with Case-Shiller. All right. So interesting article here. It's another housing bubble, and the Fed is holding the pin. One thing I'm going to tell you is that end of the year articles we're talking about double-digit appreciation, interest rates, blah blah blah. Then we had, January came into play with like, things are so deceleration, cooling of the market, whatever. Now that February's in play, we're now seeing a lot more articles, economists, analysts, real estate people talking about bubbles now. So they're actually, it's funny how things shift. Now, it's not always mainstream. Mainstream doesn't want to talk about this, but I see more and more people talking about bubble, bubble, bubble. Okay, so interesting stuff here. So there are two things for certain. There is a massive bubble, and the Fed is holding the pin. The result is skyrocketing home prices. And if the Fed continues to be the price-setting marginal buyer or big bid in the mortgage market, expanding its mortgage portfolio with one hand and printing money with the other. So yeah, it's issuing more money and it's buying a ton of mortgage-backed securities. It was buying about $40 to $50 billion worth of mortgage-backed securities a little while ago. I think it's pared down to about $30 billion. But the point is, it's buying them, freeing up other money for other lenders, which allows them to loan more money. So I do think it's kind of interesting that it's people talking smart, educated economists, analysts, whatever in the real estate world, they're basically saying that the Fed has mismanaged the entire housing market here. So ultimately what they're saying is here, so we have a massive housing bubble, even bigger than the one that popped in 2007, that led to the 2008 financial crisis. And what always happens to bubbles, they pop. No ifs, ands, or buts. When they pop, and everything kind of falls apart afterwards. What they're looking at here is that there was a massive real estate or stock market crash that soon followed when we've seen numbers like we've seen in the past with the housing here. So there appear to be no exceptions other than a few rare cases where housing prices increased quickly immediately after a crash had occurred. So ultimately what they're saying here is that like the past few bubbles and crashes, we're positioned the same way here. So we shouldn't be surprised if it happens, nor should we discount that it will happen. That's how I look at it, going, history does repeat itself, and all the things that happened back in the day are pretty much here right now, maybe a couple of little twists and turns. But we're set up for this right now, guys. We're set up for it. And realize that, as I mentioned earlier, we've had a 2-year moratorium on foreclosures and evictions. So what we've got people staying in the property longer, not paying their rent and their mortgage. We've got forbearance. We've got a lot we've had a chokehold on the real estate market for about 2 years now. So it's over, really pretty much over now in virtually every location. So now as time goes on, we're going to see how slowly it's going to manifest. Like, for example, X number of foreclosures don't just come on the market and become available next month. They have to go through a process. It's going to take months/years. But we're at the starting point of these months/years. I've already seen stuff happen down here. We're already involved in it. We want to increase in it. Now's the time. So if you don't sit on the sidelines, get involved, educate yourself on what's going on here. Now, getting back to the real estate investors are buying a record share of U.S. homes, sending prices soaring. Okay, so it looks like BlackRock got bigger. They bought America's largest commercial and residential landlord. They bought 12,000 apartments in the Sun Belt. Okay, which was pretty huge for $5.8 billion. It's one of those things that investors bought a record 18.4% of homes that were sold in the U.S. in the fourth quarter of 2021. So last quarter, 18.4% homes were bought by investors. Now, are they all the BlackRocks, America Homes for Rent, like the huge conglomerate hedge funds? Not necessarily, but they've all got money. They've usually got billions or multi-millions. And we're also seeing smaller investors enter the market. Not investors with, $100 million. That's investors with $1 million, 5, 10, whatever. So people, every day I'm talking to people going, I've just created a $5 million purchase fund for me and my buddies. We'd like to see if you can supply us with some of the product. I'm like, okay. So I get those calls all the time, all right? So everyone's got money. The key, though, is deploying it and getting access to the product, the homes, to to put in those little funds. Okay, so the point I'm trying to make though is that the investor market is moving. Is the investor market responsible for stimulating the increase in price points? Well, it's going to have some correlation here. So obviously, investor market share reaches record high in the fourth quarter. So you can see how it was on its honest. It would be up and down, up and down. That's typically, I think peak value when they buy, and then obviously you see it. 2019 to 2020, we see that the big drop there with COVID. We're hitting the big trough there, then we're back up with a vengeance. So just keep that in mind as to how that's playing out. With respect to, so that's the biggest market share. Investors bought almost 80,293 homes in the fourth quarter, up almost 44% from the previous year, but it actually wasn't the record. The record was, I guess, homes bought by investors declined by 8,000 from the third quarter peak. So there you go. So the third quarter is where, or actually, Q3 21 is where they actually bought more homes. So if you think about it, 80,000, 88,000. So within 6 months, about 100, almost 170,000 homes were purchased by investors across the board in the U.S. Now, these homes don't go back on the market as cheaper priced homes. They go out as rentals, or they're fix and flip, and they go out as high price market value homes because they can. That's what happens. So, it's like the inventory is being taken away, and then it's being pushed, the values are being pushed higher because the price point set when people put their money or their properties back on the market, because they have to make money. You bought it, you rehab it, you got to make your points on it. I get it, but it just goes to show where things are at. I look at this as almost like know thine enemy. The investment market is very actually important to the real estate industry because it contributes hugely to the GDP, number one. But two, there's always going to be a market segment of renters, regardless of, age, demographic, income, whatever location. There's always a need for rental accommodation. And since we're not building any more homes at the pace that we need, rental market's becoming more and more important. And those numbers have also skyrocketed with rent rates. So right now is a good time to be buying property, to become a landlord. Essentially, that's what these guys are doing. They're overpaying because they know the rents are up and they can take care of that. And that's kind of the interesting part of this discussion is that, like these groups, the investor money, and again, I'm speaking more like the big ones, the hedge funds, whatever. They've raised money, so they're paying cheaper interest for it, or it's a different return that's required. So they've got more flexibility in what they can buy, and typically they can outbid you or me if they want to. So the numbers they need might be less than what you and I need from a percentage perspective, you see? So this is interesting. So when you take a look at this, some of the information here is that, investors are taking advantage of the intense demand for rentals and increasing ranges, with average monthly rental payment for a new lease up 14% in December. So as price points are going up, rental rates and lease rates are going up as well too. So it's kind of like they're at the same point. So if you're matching the two with virtual same increases, then it makes sense to buy, right? Because you're still maybe netting the same amount of the same percentages in the end anyway. So summary of this is a Redfin report. This is where this has all come from. So investors bought 18.4% of all the U.S. homes that were purchased in the fourth quarter, record high. Investor demand is stronger than ever as U.S. home prices increase, allowing investors to charge for higher rents and sell flip homes for higher prices. There you go. Real estate investors bought 80,000 homes worth a total of $50 billion in the fourth quarter, up substantially from a year before. Mid-price homes are now becoming more popular with investors, making up 32% of investor purchases in the fourth quarter, a record high. Low-priced homes are still most popular with investors, making up 37%. True, but when there's less low-priced homes, then they go for the mid-price. And what happens when that occurs? Then the mid to low price categories kind of blend and change, you see. So while record home prices are problematic for individual home buyers, there's one reason why investor demand is stronger than ever. They're chasing rising prices because rental payments are also skyrocketing, incentivizing investors who plan to rent out the homes they buy. So there you go. But also, high-priced homes represented 30.7% investor purchases, up slightly from the third quarter. So high-priced homes, I think, are more fix and flip. In other words, there's a big demand for higher-priced homes. You can see where on the NAR stuff that at $500K and above, all the activities there. I know people are coming to this market, cashing out from other markets, coming down with cash, wanting to buy nice, big, expensive homes. They can do it with all cash because they come from very expensive places. They're actually getting more bang for their buck and paying less on taxes and stuff like that when they come down here. So it is very interesting how things are sort of coming to play out now. People are realizing the market is down here in the Southeast, apparently. So just keep in mind, as I said, no offense to any investor out there. This is part of the natural world, and I love I want more investor clients, and I want more stuff to happen. So reach out to me if you want to get involved with what I'm doing or understand what's going on in the marketplace here. So as I said, there's two housing markets in play right now. Okay, the mainstream retail market, which we talk about, and all the news articles talk about it. We're starting to see a little more change, talking more about bubbles and some potential problems. We start slowly. It's like, well, cooling of market, and then home buyer sentiment, and now interest rates. Oh, and now bubble talk. So you see how we're inching more and more down the path of future problems we're not talking about yet, but we'll talk about it maybe next month or two. So it's starting to move the median or the middle point starting to move down one direction now. The shadow inventory is all the homes that are in pre-foreclosure, facing foreclosure, forbearance, in probate, code violations, distress, the whole bit. This is the shadow inventory. These are not on market, but they're there. And if they all came on the market at once, they'd certainly make a big impact with respect to house price points for sure. But that's where the inventory is. The inventory is not an available inventory. You have to go get it, find a way to get your hands on it. They're not floating to the top saying, help me, help me. That's the difference in this type of marketplace. But the point is, it's there. There's a huge volume there, anywhere between 3 million to 10 million. That's still a nebulous number, but I think we're getting closer to that number soon enough, what the real number is. But that's why I talk about distress and playing in the shadow inventory. It's certainly much more interesting, and that's where you're going to find your deals with respect to investing, of course. And I do believe that people who are looking for primaries need to now sort of blend investor techniques to find your primary residence, okay? Well, things are overpriced. We're not going to find anything. Well, here's a perfect example of a recently closed short sale I did for a client the other month. And you can see the mortgage balance was $340. Negotiated purchase price was $172. A 49% discount off the mortgage. Instant equity of about $177. Stopped the foreclosure sale. Got this done in about 53 days. The Zillow numbers, you can see the Zillow midpoint's $353. It's about $375 at that point in time as far as the high end. And now we're at about $400. Okay. So the point is what I'm making here is that these do exist. They're just not readily available or optically available that you can pick off MLS or Realtor.com, Zillow, whatever. You see, so this is a different way of doing things. But the point I'm trying to make is that you can do these type of things. This is available. And mainstream media, when I talk about two separate housing markets, mainstream media and Wall Street and the lenders and big biz, whatever, government, they don't want you knowing about this. They want you to keep buying that home, taking that mortgage, looking forward to your double-digit appreciation, because that's what they want you to do. Okay, they've brainwashed us. Whereas, look here, there's a ton of opportunities behind the scenes that they want you to forget about. So all these can go to foreclosure, and those who can pick them up at the auction for themselves. So there's a real, and I've thought about this for a long time of how this is all changing. And all of this past year to me has been nothing about narratives, and exactly what's been played out now. We have a housing narrative playing out right now, and the design is for you to not realize what can happen and what's going on behind the scenes, below the radar, shadow inventory, etc. So please realize that. Okay. I'm involved in some build-to-rent, build-to-flip projects. I got that underway now if you want information on that. And this is investor opportunities, right? Get land, build with an investor, developer, construction company that's got lower priced, per square foot, either resell to flip or put a rent to rent, and you're doing better, okay? When we start working the numbers and we see that things are going for like $300 a square foot, when we can do way better than that all in, there's equity and margin there. I'm also working on my distressed deal architect sort of beta program here. I've only got 25 spots available. I've got 11 or 25 commitments going on. I want to fill it up by the end of the week here so I can launch this and get going, because I got stuff happening. I've been contacted by a lot of people, and stuff's accelerating faster than I anticipated. So a lot of stuff's going to happen. I want to get that out of the way so we can get going on that, because there's more to come down the road. Also, my short sale program, if you're looking at that, I suggest you jump on it now, because it's not going to be available for much longer. I keep saying that, but now we're in play on a lot of other things that are going to happen in the near future. So great opportunity to learn from the ground up on how to work these deals like I just showed you there. So please reach out to me if you want more information on all this stuff. Here's something I do need from anybody out there. Working on a 24-unit townhome development project here. So got the land controlled. We have the county has approved that site plan for 24 townhomes. Now we're just pricing things out, and I'm looking for partners, so strategic and financial partners to pull this off. So they don't make more land. This is infill land in the suburb of Tampa, and this is not out in the boonies anywhere. So there's a good opportunity. So if you're interested in stuff like this, give me a shout and we'll talk. All right, guys. So that's what's going on here. A lot of stuff happening in the marketplace today. So if you want to engage, send me an email with your phone number so I can get a hold of you. I know people I have to get back to have inquired about the 25 spots available on the direct the stress deal stuff. I'm going to get to you for sure. Obviously been busy. Things are just picking up. That's all I can say now, guys. Things are picking up. More inquiries, more information, more stuff happening, more deals on the flow. So let's get going on this. So once again, guys, thank you for the views, likes, comments. Please share the video with your family and friends. Not a subscriber, please subscribe, and we'll look forward to speaking with you in a few days. Thank you.